Welcome back to the Forex Lounge Fundamental Extras. Today is Friday, May 21st, 2010. Welcome back, one and all. Great you could join us. Today, Bloomberg.com reports Canada's annual inflation rate accelerated in April, and retailers saw sales increase at the fastest pace in 5 years, giving the central bank more scope to begin raising interest rates as soon as next month. Consumer Price Index rose 1.8% faster than 1.4% previous month, led by car and gasoline prices, Statistics Canada said today in Ottawa. The agency reported separately that retail sales gained 2.1%, the 10th gain in 11 months to reach a record. Getting to the chart to see how this translates. The blue line represents the Bank of Canada Consumer Price Index, CPI. Again, this month recording a level of 1.8, better than the previous month of 1.4. The violet line represents its own 12-month moving average, and we can see the CPI has continued to rise to the upside after hitting ultimate lows August of last year. Now, when the Consumer Price Index rises, it gives the central bank more reason to raise interest rates. The expectation of higher rates tends to lead to strength in that currency. The Bank of Canada interest rate history is the blue line, currently at 0.25%. They have not adjusted interest rates since cutting them from all the way back to April of 2009. And the CAD CPI is represented by the violet line. Now we can see, generally speaking, over time, when the Bank of Canada cuts rates, or when the CPI drops, the Bank of Canada cuts rates. When the CPI rises, the Bank of Canada tends to raise rates. So the recent rise in the CPI in Canada could lead many analysts to believe the Bank of Canada will raise rates. The next chart shows us the CAD CPI, that's the violet line. The TSX is the Toronto Stock Exchange. And we see, generally speaking, over time, as the CPI drops, the TSX, the index, goes down. When the CPI rises, the index tends to rise as well. So a stronger or an improving CPI tends to lead to strength in stock markets. And finally, we also look at the CAD CPI, that's the violet line, against the dollar-CAD currency pair. Now, the dollar-CAD, the CAD is a second currency within the pair, so we have to look at this from an inverted point of view, meaning when the CAD goes up, the dollar-CAD goes down. When the Canadian currency goes down, the dollar-CAD goes up. So we're looking at the CAD CPI. As it falls, the dollar-CAD tends to go up. When the CPI rises, the dollar-CAD tends to go down. So if we expect CPI to continue to go up, this may bode well for Canadian strength in the dollar, and it may bode well for the dollar-CAD to continue to go down. And we can also see this relationship very simply with the dollar-CAD currency pair, that's the blue line. The TSX, the Toronto Stock Exchange, is the violet line. When the dollar-CAD goes down, it means strength in the Canadian dollar. The TSX tends to go up. When the equity index goes down, the dollar-CAD goes up. An inverse correlation. We hope this has been helpful. If you have any questions, email us anytime, info@forexlounge.com. We thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside the Forex Lounge.